Hi, welcome back. Something happened this week that a lot of everyday investors are still trying to wrap their heads around, and honestly, it's worth slowing down and understanding properly. Silver just pushed through the $60 mark, and it didn't do it quietly. This wasn't a slow grind higher over months. This was a sharp, fast weekly rally that caught even seasoned traders off guard, and the trigger behind it wasn't some secret metals report or a sudden supply shock. It was something far more familiar to anyone who follows the economy: weak jobs data out of the United States. Today we're going to break down exactly what happened, why a jobs report can move silver prices this dramatically, and what levels traders are now watching next, specifically that $62 to $65 zone that's coming into focus. By the end of this video, you'll have a clear mental framework for understanding why silver reacts the way it does to economic data and what this current setup might mean going forward. Let's start with why this matters right now. Silver isn't just a shiny metal sitting in a vault somewhere. It sits at this unusual crossroads between being a precious metal, something people turn to during uncertainty, and an industrial metal, something factories and manufacturers actually need to build things. That dual identity is exactly why silver can move so sharply when economic data shifts, when something like a jobs report comes in weaker than expected. It doesn't just affect one part of silver's story, it can affect both sides at once, and that's part of why we saw such an aggressive move this past week. So let's break down what actually happened. The latest United States jobs report came in noticeably weaker than economists had expected. Fewer jobs were added than forecast, and some of the underlying details like wage growth and labor participation also showed softness. Now here's what this means in practical terms. When the job market shows signs of cooling, it tells the Federal Reserve something important, that the economy might be losing momentum faster than anticipated. And when the Fed sees that kind of signal, the conversation around interest rates shifts almost immediately. Think about it this way. Interest rates are essentially the price of holding cash and safe investments like bonds. When rates are high, cash and bonds become more attractive because they pay you more just for sitting there. But when the labor market weakens and the Fed starts leaning toward cutting rates, that changes the equation. Suddenly, holding cash isn't as rewarding, and investors start looking for other places to put their money. Precious metals like silver and gold, which don't pay any interest at all, become relatively more attractive in that environment because the opportunity cost of holding them just went down. This is the core mechanism behind what we saw this week. Weak jobs data increased expectations that the Federal Reserve will move toward cutting interest rates sooner rather than later. That expectation alone, even before any actual rate cut happens, is enough to move markets. Traders and investors don't wait for the official decision. They position themselves ahead of time based on what they think is coming. And this week, a lot of that repositioning flowed straight into silver. Now here's where it gets a little more interesting, because silver's move wasn't just about interest rate expectations. There's also a currency angle to this story. When the labor market weakens, it often puts pressure on the US dollar, because a softer economy typically means less attractive returns for foreign investors holding dollar assets. And here's an important relationship to understand. Silver and gold are priced in dollars globally, so when the dollar weakens, it takes fewer dollars to buy the same ounce of silver in relative terms, which mathematically supports higher prices even if nothing else changed. Combine that dollar softness with rising rate cut expectations, and you get a pretty powerful 1-2 punch that pushed silver decisively above $60. Let's talk about why $60 specifically matters, because round numbers in trading aren't just psychological, they often coincide with real technical significance. $60 had acted as a ceiling for silver in recent trading, a level where sellers had previously stepped in and pushed prices back down. When a price breaks through a level like that with strong momentum, especially on a fundamental catalyst like this jobs report, it often signals that the balance of buyers and sellers has genuinely shifted. Traders who were previously cautious around that level start to view the breakout as confirmation, and that can bring in additional buying interest, which is part of what extended the rally through the week. Now this naturally brings us to the next question, and it's the one a lot of you have probably been asking: what happens next? Where does silver go from here? Based on current price action, the next levels traders are watching sit between $62 and $65. Let's break down why these specific numbers matter. The $62 area is being viewed as a near-term resistance zone, meaning it's a level where some profit-taking could occur after such a sharp move higher. It's completely normal for a metal, or any asset really, to pause or pull back slightly after a fast rally, even if the underlying trend remains strong. That's not necessarily a bad sign. It's often just healthy consolidation. The $65 level is being watched as a more significant resistance zone. If silver can push through 62 and maintain momentum towards 65, many market participants would view that as confirmation that this isn't just a short-term reaction to one jobs report, but potentially the start of a more sustained upward trend. On the other hand, if silver struggles to clear 62 and starts drifting back down, that could suggest the market needs more time to digest this move before attempting another leg higher. Both outcomes are entirely possible, and it's important to hold that balanced view rather than assuming only one direction from here. Let's zoom out for a moment and talk about the bigger picture, because a single jobs report, as important as it was this week, doesn't exist in isolation. Silver has been dealing with a supply and demand story that's been building for years now. On the demand side, industrial use of silver has been climbing steadily, driven by solar panel manufacturing, electric vehicles, and electronics that require silver's excellent conductivity properties. At the same time, mine production hasn't kept pace with that growing demand, and silver is often produced as a byproduct of mining other metals like copper and zinc, which means supply doesn't always respond quickly, even when prices rise. This structural backdrop matters because it means silver was already sitting in a relatively tight supply environment before this week's data even came out. The jobs report acted more like a spark than the entire fire. It accelerated a move that some analysts had already been anticipating, just perhaps not this quickly. Now, let's take a moment here because I know some of you are new to this channel and might be wondering why any of this actually matters to you personally beyond just watching numbers move on a screen. Here's the honest answer. Understanding how precious metals respond to economic data gives you a broader lens for understanding the economy as a whole. Silver's move this week is really a reflection of changing expectations about growth, employment, and monetary policy. Even if you never buy an ounce of silver in your life, understanding why it moved the way it did helps you read the bigger economic picture more clearly, and that kind of awareness is genuinely useful when you're making financial decisions of any kind, from saving to investing to simply understanding the news. If you're finding this breakdown helpful, consider hitting that subscribe button, because we cover moves like this across silver, gold, and the broader macro picture regularly, and it genuinely helps more people find this channel when you engage with the video. Now let's get back into it, because there are some risks and alternative perspectives worth acknowledging here, and I think it's important to be balanced rather than just chasing excitement around a big rally. First, it's worth remembering that a single jobs report is just one data point. Economic data gets revised, sometimes significantly, in the weeks and months that follow. If future reports come in stronger than expected, or if inflation data shows unexpected strength, the Federal Reserve's path could shift again, and that could cool some of the enthusiasm currently driving silver higher. Markets that move quickly on rate cut expectations can also move quickly in the opposite direction if those expectations get reversed. This is why chasing a rally purely out of fear of missing out can be risky. Prices that move up sharply can also correct sharply, and volatility tends to increase, not decrease, after big breakout moves like this one. Second, silver has historically been a more volatile metal than gold, precisely because of its industrial demand component. That means during periods of economic uncertainty, silver can sometimes fall faster than gold if fears shift from inflation concerns toward recession concerns, since a weakening economy could eventually reduce industrial demand even while boosting silver's appeal as a monetary asset. This is why some analysts watch the gold-to-silver ratio closely, as a way of understanding which of these two forces, industrial demand or safe haven demand, is currently dominating market sentiment. So how should you think about a moment like this without getting swept up in either excitement or fear? Here's a simple mental framework that might help. Try thinking of silver's price action as sitting at the intersection of three forces: interest rate expectations, dollar strength or weakness, and physical supply and demand fundamentals. When two or more of these forces align in the same direction, like we saw this week with rate cut expectations rising and the dollar softening at the same time, moves tend to be sharper and more decisive. When these forces are pulling in different directions, Price action tends to be choppier and less directional. Right now, at least two of these three forces appear aligned in a way that's been supportive for silver, but as we discussed, that alignment can shift as new data comes in. Looking ahead, there are a few scenarios worth keeping in mind. And again, I want to present these in a balanced way rather than predicting a single outcome. If upcoming economic data continues to show softness in the labor market and the Federal Reserve leans further toward cutting rates, that combination could continue supporting silver's move toward and potentially through the $62 to $65 zone. Alternatively, if incoming data surprises to the upside, showing the economy is more resilient than this recent report suggested, we could see some of this week's rally cool off as rate cut expectations get pushed back. There's also a middle scenario, where prices consolidate in this new $60 to $62 range for a while as the market waits for clearer signals from upcoming inflation reports and the next Federal Reserve meeting. Each of these paths is realistic, and rather than trying to predict exactly which one plays out, the more useful approach is staying informed and understanding the forces at play, which is exactly what we're doing together in this video. It's also worth touching briefly on how this connects to real life beyond just trading charts. Precious metal price movements like this one often ripple into related areas that affect everyday people, from the cost of manufacturing certain electronics and solar equipment, to how retirement portfolios that include metals exposure perform, to broader signals about where the economy might be headed in terms of jobs and interest rates on savings accounts and loans. None of this means you need to rush into any decision, but staying aware of these connections helps you make more informed choices about your own financial situation, whatever that looks like for you. Before we wrap up, let's do a quick recap of everything we covered today. Silver broke decisively above $60 this week, driven primarily by a weaker-than-expected United States jobs report. That weak data increased expectations of Federal Reserve interest rate cuts, which made non-yielding assets like silver more attractive relative to cash and bonds. At the same time, dollar weakness added additional support to the move. The next levels traders are watching are $62 as a near-term test, and $65 as a more significant confirmation level for continued upward momentum. Underneath all of this, silver's longer-term supply and demand backdrop, shaped by growing industrial use and constrained mine production, continues to provide a structural foundation for the metal's price behavior. And importantly, this story isn't finished. Upcoming economic data, inflation reports, and Federal Reserve decisions will all play a role in shaping what happens next. So here's the thing to take away from all of this. Markets like silver don't move in isolation. They respond to a web of interconnected signals, from employment data to interest rate expectations to currency strength to physical supply and demand. Understanding those connections doesn't just help you follow one specific rally. It gives you a lasting framework for understanding markets more broadly, no matter what's happening in the headlines next week or next month. That's really the goal here. Not to chase every headline with excitement or fear, but to build a genuine understanding of how these pieces fit together. Thanks for spending this time with me today. If this breakdown helped clarify what's happening with silver right now, let me know your thoughts in the comments. I read through them, and it genuinely shapes what we cover next. Stay curious, stay informed, and I'll see you in the next one.